Hey everybody, Warren Buffett hates airlines. So what? So today I'm going to talk about Warren Buffett came out over the weekend and said how he sold all the airlines. He basically said he hates airlines. And so the question is, so what? What does this mean for us as investors? What does this mean for people that work for airline companies? What does it mean? And so I'm going to make some arguments, but before you start saying that I'm a lesser person than Warren Buffett, I couldn't carry his water, whatever the cases are, I like Warren Buffett. I think he's a super individual. I think he's done net good. You know, some people will argue about his politics. I don't want to get into any of that. I think, that he's been a tremendous investor over the years. Okay, so let me get that out of the way first before I get all the hate mail. But I think there's some things that actually we can learn from what Warren Buffett did over the weekend and in April when he sold the airlines. I think there's some tremendous things that we can learn. Things is a terrible word. There's some tremendous concepts that we can learn about how markets work. And so what I will argue is that the world is not black and white, but gray. Okay, so you see headlines today, and the headlines either say good, bad, ugly, pretty, whatever it might be. And so people will say, well, Warren Buffett sold the airlines, therefore bad, bad, bad. And I don't think it's that easy. I really don't think it's that easy. So what I'm going to argue is that Buffett knows what we all know. Now, has he had good investment wisdom over the years? Yes, he has. But he still knows everything that we know. He's still a human being as far as I can tell. Buffett does not know the future, and neither do we. We can all make predictions. Everybody can make a prediction, and Buffett made a prediction and said, I'm selling. And he has that right to do it, and he did it. But he does not know the future. Now, he said some things on the 4.5-hour webcast, which I did watch. I watched the first 3 hours in real time. It was a little bit painful because he did not have a live audience, but he said some things. So the next thing is Buffett is human. Again, as far as I know, he's 89 years old. And he has the same heuristics and biases that we all have, and it says see below. So I'll show you some of the quotes that he actually not only has said, but written. And so he is a human being, and he has heuristics, which are the mental shortcuts. He has the biases, which are things that he either likes or doesn't like for reasons that he thought about prior. And so Buffett has a great past, but efficient markets have been right more often recently. And so this one is the one where I could hook an oppositional streak in somebody. But all I'm saying is over the last 10 years, Buffett has not outperformed, Berkshire has not outperformed the S&P 500. Now, most people have not, okay? The S&P 500 has done tremendous. But the index or the market and efficient markets go together, and I'm going to talk to you a little bit about efficient markets, even though you don't think you know what they are, and you probably don't even think you know that you care about what efficient markets are. But I'm going to argue it a little bit in a way that I hope is interesting. What I will not argue is that I'm smarter than Warren Buffett, that one should buy or sell airlines based on this presentation, that Buffett has lost his touch. I'm not going to argue any of those things. So what do we all know? Now, we are the collective market. We are the world. We are the collective market, all of us, everybody, including Buffett, including Berkshire Hathaway, including everybody that's out there buying and selling stocks. Well, we know planes are not flying nearly as much as they were. A lot of planes are parked. We know that some planes are flying, and they're not full. They're still moving some freight, but they're not moving a lot of passengers, at least as of today. We know the past, and we know today, this moment in today, whatever time that this video is being made, 11:46 a.m. on May 5th. That's what we know as of right now. And that's all that we know. We don't know the future. So what does the market know? It knows up till today. Everybody knows that. Millions of people have decided what the prices are as of today of airline stocks. Okay? Now let me get to the presentation here. So I think this is really interesting. But let me see if I can move this over to here. I'll even let you see what the next slide is. So the first slide. Together, we know more than we do alone. This is the idea of efficient markets, okay? You take a big thing of jelly beans and you ask a group of people, how many jelly beans is in the jar? It's called the wisdom of crowds, right? So the people will guess anywhere between 409 and 5,365. That's a pretty wide range, but when you take all the people's guesses and you average them out, they actually come out pretty good. So this is the wisdom of crowds. It's also efficient markets. You see, every day, market participants, every day, people decide what should be the price of Delta. Is it too high? Is it too low? All the things we know, I'm going to buy, I'm going to sell. People around the world, as a matter of fact, $462 billion worth of trades every single day. So people are setting the price. Now, is the price right? We don't know if the price is right. All we know is that that's the market guess. And so when Warren Buffett decided in April that he was going to liquidate all his positions after selling some in March, he liquidated those positions against everybody in the world that was saying they thought the price was a pretty fair price. So he was selling. Other people were actually buying. Somebody was buying the shares that Buffett was selling. So that's important to know, that there's lots of people deciding what should be the price of airlines. And he's only one opinion. Now, he's a good opinion, but he's only one opinion. So people usually trust the prices, okay? So Monday you go to the fish market. If you could go to the fish market, you'd be wearing a mask. $6.50 on Monday. On Wednesday, you come back at $7.10. On Friday, at $6.85. Okay, the same is absolutely true with the stock price. Stock prices can go up and down. And the reasons why they go up and down is a little differently than fish, but similar. So what affects today's stock price in Delta, in United, in, what were the other ones? American, in Southwest. What affects the price? All available information. So a company's equity is its prospects for the future, earnings, and perceived risk. And so all of these things go into what the price is. Now, is the price right? Who knows? It's just our best guess. And then what changes the price of a stock? So this is looking at markets reacting to events. So orange juice futures surge to a record on fungicide fears. So if you watch the moving trading places, I think it had to do with orange juice futures. Maybe I'm wrong, but I've seen the movie a long time ago. But prices adjust when there's unexpected events, okay? So the price on Friday, January 6th, is $27.57. Boom, the report hits. There's fungicide fears. Oh my God, it's a different virus or a fungus. I don't know what a fungus is, if it's a virus or not. But immediately on Friday that comes out, and then Monday the price of orange juice is higher. And that's because new information came that changed the price. And that's exactly what happened with the coronavirus and airplanes. Okay, now here's actually a Berkshire Hathaway in our DFA presentation about how prices adjust really quickly to new information. So this was Heinz. So Heinz was going along here in 2013, and then all of a sudden Berkshire Hathaway starts buying tons of shares. Bam, the price goes up. Bam, the volume of trades go up. Everybody starts trading because some people think, well, this is great news, I'm going to buy. Other people think, well, the price has gone up now, I'm going to sell. And so as you see here, the volume before the news is really low, and then after the news, the volume actually is higher, but there is a spike. And so you can see that a new price is set. So the opposite would be if we can flip this around and say coronavirus airlines, boom, the prices go down in airlines, and then the prices have been pretty stable, somewhat stable since then. So what was so interesting about Warren Buffett was that he came out on Saturday and said he sold all his airlines. What ended up happening is Monday morning, this airline stock was down 15% intraday, which just means in the middle of the day. This happened. This efficient market happened, okay? On Friday, the prices of the airlines was here. Saturday, Warren spoke, and then Monday, oh, whammo, prices adjusted to the fact that Warren sold. So once again, markets look pretty efficient. So here's the interesting part about efficient markets and the theory that prices will adjust to new information is that sometimes it's not that the news is better. Okay, so we're going along, we believe what we believe, the news is better than we expect, and prices go up. The news is worse than we expect, and prices go down. This actually came out this morning. April's non-manufacturing index comes in at 41.8 versus 40 that's expected. Now, both of these numbers are terrible. It doesn't matter what the index is. I'm just going to tell you that people expected things to be really bad, a 40, and things came in better. So they were less worse than expected. And you can see down here that the S&P, maybe partly because of this news or other news, or maybe just because people felt like buying stocks today, the S&P 500 is up 1.63 at the time that this hit. So back to our presentation here. Picking the fastest lane is a stressful game. Trying to choose which stocks to buy or sell is very, very stressful. Not only is it stressful, but it's really quite impossible to do. Or not impossible, improbable. So 20-year period through 2018, these are all the equity funds that were out there. Only 23% of the funds actually beat the index. Okay, only 23% actually beat the index. Buffett did not beat the index last year. Last 10 years. It's very hard to beat the index. But this whole idea that someone is smarter than everyone else is that when Warren Buffett decides to sell all the airlines, or Berkshire Hathaway, his team, they're going against what the prices are for every other market participant. Now, has Warren been smarter? Well, he had been smarter for a whole number of years. But do you want to be the person like Warren now if you are holding airline stocks? And again, we're not saying you should buy or sell them, but do you want to now say, well, Warren Buffett has done this, so I'm going to jump into the seat of the person that's now going to go against the market? I don't think Warren Buffett should do that for us. I really don't think he should. So this is the last slide that I'll show, and this is the reason why, for the most part, when Charlie and I get asked about owning individual securities, we always say the same thing. Individual securities can make you rich, but they can also make you very, very poor. Concentrating in one stock gives you the returns of one stock. If you own a diversified group of stocks, you'll do better. So, Warren Buffett took a very concentrated position in airlines. That's what he did. He owned 4 airlines, very concentrated position. And not only did he do that, but he bought high and he sold at a much lower price. He said that. So I'm not guessing that. He said that. If we pull the charts up, we can see that. So here's back to my sheet here, and I'll show you a few more quotes about one of the things that really makes me doubt if Warren really knows if it was a good decision or a bad decision to buy or sell the airlines. But what the market does not know, and why we don't recommend individual stocks, nobody knows the future, including Warren Buffett, okay? So he thought he knew the future. He bought all these stocks, all these airlines, and then the news was worse than expected. So more importantly, will the news be better or worse, or less better or less worse than expected, than we predict today? Very hard to do. And then what changes stock prices? Again, I think I've made this argument. Future information that is by its very nature unknowable will change markets. Okay, what governments do in the future, we can guess what they will do. I know when I worked for a drug company, we used to think they're going to definitely approve this drug. They didn't do it. We thought there's no way they're going to approve the drug, and they did. What companies, CEOs, and employees do in the future? What will the airline companies do? Boeing floated a lot of bonds. That was something that people said weeks earlier they could not do. And when I say floated a lot of bonds, they had people loan them a lot of money. So does it feel good to work for an airline company right now? No, of course not. It does not feel good. Just like it knows, everybody has an opinion on if it's what's going to happen. We don't know. So here's my arguments about some of the things that Warren has said or written about over the years. These are all things that were in his annual report, and why I think he possibly, I'm going to use the word possibly, got spooked out of owning airlines. Okay, I think he had a heuristic, a mental shortcut, and a bias that he did not like airlines already. And then when the virus came along, he decided to sell. Again, I'm not saying it's a great time to buy airlines. I don't know, but this is what I think he did. So he said the lowest cost carriers can disrupt rivals. As the seat capacity of the low-cost operators expand, their fares begin to force the old line, high-cost airlines to cut their own. Eventually, a fundamental rule of economics prevailed. In an unregulated commodity business, a company must lower its cost to be competitive, to be at competitive levels or face extinction. So he said this in the 94, again, why he was not buying airline stocks. And then he said in 1996 that profitability is not even something that can be sustained. He says U.S. air revenues, and I won't read this, but basically he said just because an airline is doing well doesn't mean it will continue to do well. And then when the airline industry is bad, it's really bad. So when he purchased the 4 airlines, his past self actually said this. Unfortunately, 1991 was a decimating period for the industry as Midway, Pan Am, and American West all entered bankruptcy. So he knew this had happened before, and he said, stretch the period over 14 months and you could add Continental and TWA. He knew this, and yet he bought the airlines. And then when the virus came along, he sold. So the final thing is, investors have poured their money into airlines for 100 years with terrible results. It has been a death trap for investors. He said that in 2013. And these all came to us through the Motley Fool, so I want to give them affirmation. I think the bottom line here, though, is that if you're a pilot, if you're an investor, I think Warren Buffett selling is very important. But I would come back to you that this is the market. These are all the companies in the markets. There's thousands of companies in a market, and we believe the market is somewhat efficient, or at least we should act as if the market is efficient. And because Warren Buffett decided that airlines, were a terrible place to invest, does not necessarily mean we should all agree with them. So thanks for watching. Love your positive feedback. Thank you.